Hello, good morning, everyone. Hello, can you hear me? Everything is okay?
Yes.
Yeah, good morning.
Wonderful, good morning, good morning. Apologies for moving this lecture from last week. I'm in a better condition now, so we can continue. Today is a lecture. Tomorrow at 9 a.m. we'll have a midterm. Nothing really, I would say nothing really to worry about. It is just, it will be a recap of what we have learned about market microstructure and a little bit of statistical methods. It will include the material which we are going to discuss today as well. So everything up to and including today's Monday lecture will be in the midterm.
I have a question.
Yes, please.
So then the current lecture will be posted today because our classmates are like worrying about it.
Yes, I will post it today. I think everything up to and including the previous one already available.
Yeah, okay, thanks.
All right. So basically, this is, I think, a very good time for a midterm, because in the first part of this course, we're studying our application domain. It is not possible to do some kind of, generic data mining without a very thorough understanding of the application domain. We really need to know if, for example, we perform data normalization, data cleanup, it must not be just, some kind of generic application of statistical methods. We really need to know what it is all about. So, for example, in our case, we know that there are data consistency properties, which are related to the order book correctness, the structure of bids, asks, subsequent operations, the asks spread, and so on. So obviously we do study the application domain, and based on that, we apply our data cleanup and normalization methods with a full understanding of what it actually means in this particular case. Then the second phase, which will start after the midterm, will be using the features we have generated for continuous price prediction and maybe some other activities. So we'll be really doing the first stage of machine learning based on the data we have mined. I believe all of you had already had a machine learning, some kind of machine learning module. Is it correct?
Like a course?
Yes.
Yes.
Okay. But again, correct me if I am wrong. I think that was more about the methods of machine learning rather than applications. So, for example, you were studying in depth the construction of neural networks, various methods of how to achieve convergent gradient descent, and so on. So that was more about the methods, construction of machine learning methods. Is it correct?
Yes.
Yes.
But did you tackle any real machine learning based problem? So, for example, really just, given a data set, trying to learn something about it and predict whatever property actually we want to predict. I mean,
yes.
We had some computer vision task where we have to recognize handwritten digits with some different domains.
Okay, that is obviously, I would say, the very common and standard benchmark for machine learning. And you were doing this probably using the so-called deep learning methods. You are constructing neural networks interleaving fully connected layers with convolution layers, something like that. Is it correct?
Yes.
In that exercise, how many layers did you have in your neural net all together?
I think it depends from like 4 layers to I had like 20 layers.
20?
I had an ensemble of 5 layers, 5 layers models, so it was 5 by 5 or something like that.
Okay, okay. So basically, and I think you were interleaving fully connected and convolution layers and maybe something else, right?
Yeah.
Okay. It's interesting actually, because the general, I would say, strategy of what would be the best way for example, where to introduce a convolution layer and how many nodes it would have compared to the larger fully connected layers and so on, and how to do convolution. I think it is still a kind of, it is a matter of the art rather than science. Is it true? So how did you do it?
Yeah, like as we study in machine learning in general, till now we don't have interoperability, like interpretability of the neural networks right now. So it's like testing and to increase something or tweak some hyperparameters and stuff like that.
So basically manually by trial and error trying to find the best performance on in-sample data and then trying to recognize out-of-sample data, right?
Something like that.
Okay, so this is indeed one of difficult and yet unresolved problems in machine learning. In this data mining course, we will, based on the features we have collected, also attempt some kind of machine learning, even I would say a more difficult one, because we will be applying machine learning to time series. So basically, what we are constructing, we have been constructing so far, are time series of, starting with time series of prices, well, not even of prices, of orders. We construct the time series of order book snapshots, and from them, for example, of prices, VWAPs, bid-ask spreads, and so on, with our ultimate objective, one of them being able to implement continuous price prediction. Why continuous? It means that at any time t, continuously, as time runs, as time flows, we will be trying to predict the price dynamics, let's say the next maybe a few seconds or a minute, not very far, but even a few second prediction will be of tremendous importance in practice. I was talking about, if you remember, the market making algorithms, and in that setup, even a short-term prediction, we'll be talking about that more today actually, will be of very significant importance. Okay, please bear with me just 1 minute. I'm connecting my handwriting tablet and we'll continue. Okay. Okay. So to begin with, where are you now in your lab sessions? I believe you should have completed the task with Kolmogorov-Smirnov criterion, and you are now able to tell whether the order book spectra or liquidity distributions are, let's say, same for bids and tasks, or let's say same for other setups we have considered. Have you done that?
Yeah.
Okay. So what are your conclusions? We, if you remember, and remind me, please, as well. So we were considering several order book spectra. So it was what actually? First of all, bids and asks, and what was the other pair we compared them with?
We compared bids by count with bids by time, ask by time, and ask by count, bids
Okay.
by count.
Okay. Yes.
So
Yes. That's very important. So can you tell me, please, so what are your findings about this?
for all of them almost were like above the p value. The p value, the d value was above the.
All of them
HCM.
are above the k value.
Same here. Yeah. Same for me.
Oh, that's
like a lot of distributions are similar.
Yeah.
Sorry, similar or dissimilar? Because if
Similar.
Similar.
But then
And only some of them are not.
Sorry, let me say again, like all the d values were below the alpha 0 value thing.
Let's say all d values were below the k alpha values for a given.
Yes. Yeah.
Below k, that's important because you said above k. Above
Sorry.
k means they're dissimilar.
Yeah. So all of them were similar.
All of them are similar. Okay, that is already a good thing to do. Okay, because first of all, this allows us to use a more simple to construct count-based averaging, for example, if we want. Okay, and you say bids and asks are in general similar as well.
Yes.
So you constructed, yes, you constructed the average bid for a day, the average ask for a day, for example, and using the Kolmogorov-Smirnov criterion, you did not reject the null hypothesis because your statistics was below k alpha, so it was something like square root of n dn was less than k alpha for a given alpha. All right.
Exactly.
So H0 is not rejected in that case. Okay, great. Now, this is a very good result already. Let us maybe invent a few more metrics, which are important. And then we will start implementing them and we'll be using them as features for our machine learning. So what exactly we're going to learn and we would like to learn. We will discuss today. So basically, what is the order book spectrum? This is a normalized quantity, the number of contracts which are placed in the corresponding side of the order book, all right? But we can ask the opposite question. So the spectrum, after all, what is spectrum, which we constructed so far? Spectrum is a map. What kind of map? It is a map from, let's say, a relative distance from the top of the book, all right? Distance from the top of the book. To normalized quantity at that distance. You would probably agree with that, right?
Yes.
Okay. Now we can construct the inverse map. Why it might be useful? Because if we use those maps as features in our machine learning, then the machine learning itself, whatever method we are going to use, so for example, we're constructing a neural net, it would not need to spend, let's say, extra connections or nodes or whatever in order to establish this inverse map if it indeed tells us something. So what would be the inverse map? The inverse map is the map from quantity to, you can say, distance from the order book or VWAPs. So let me put it, and by the way, this is a very important thing. This inverse map is sometimes called liquidity bands. So the idea is the following. You already remember that we constructed VWAPs, volume weighted average prices. You remember that, right?
Yes.
Should I repeat actually what it is, or you remember it all well?
Yes, please. I don't remember.
Okay. So VWAP is a volume weighted average price. It is a very important concept. Volume weighted. By the way, this might very well be a simple exercise in tomorrow's midterm. Given an order book, construct the VWAP. How it is constructed? Suppose that we have an order book. It is constructed separately for bits and tasks. So for example, we have some kind of price, for example, 100 here, 101, 102. At 100, there are contracts for the quantity 1, 3, and 2. At 101, there are contracts for 5 and 7. At 102, there are contracts, let's say, 5, 3, and 2. Okay, then suppose that someone would like to buy aggressively lift the quantity of 20 contracts. Okay, so the question is, for which price they will get this quantity of 20? Of this 20, they will get 1 plus 3 plus 2, which is obviously 6. They will get at the cheapest price store, 100, right? 100.
Yes.
The extra 5 plus 7, which is 12, and they need to fill 20 altogether, all right? So the extra 12, they are going to get at 101. Now, this is still short of 20. This is only 18. Therefore, what happens in this case? They completely eat up the price level 100. They completely eat up the price level of 101. They get 18 in doing that. And from the price level of 102, they get only 2. And the rest, so 3 are eaten out of 5, 2 are eaten out of 5, and the remaining 3 plus 3 plus 2 remains. 3 plus 3 plus 2. By the way, this order of 5 in our orders log will appear as changed. You remember there is an action change because it is a partially filled. Okay? So extra 2 at 102. So what is the average price at which they get it? So the average price is 6 over 20 times 100 plus 12 over 20 times 101 plus 2 over 20 times 102. Or equivalently, you can calculate the total price for this quantity 20 and divide it by 20. All right. So you can compute what it is actually. Let's do a simple calculation. What we get in this case. So we get 620 times 100 plus 1220 times 101 plus 220 times 102. The average price is exactly 100.8. Okay. And this is indeed VWAP. It is a volume weighted average price on the ask side for a given quantity. So to compute the VWAP, you consider the corresponding side of the order book and imagine that an aggressor is going to aggressively acquire the corresponding quantity. You calculate the total price, the total cost of acquiring this quantity and divide it by the quantity. And you get the average price for the corresponding quantity or volume. Volume is quantity. That's why it is called volume weighted average price. So what we can probably do, we can construct some kind of standard bands. For example, on sufficiently liquid international, not Russian, FX platforms, the standard bands like international ECNs, international currency platforms. The standard bands are 1 million, maybe 2 million, 5 million, maybe 3 million sometimes as well. 5, maybe 10 million, maybe above 10, but something like this, 1, 2, 5, 10, okay? Something like that. And then for each band, so let's say this is a B value, you construct the series of VWAPs. VWAP as a function of B. And obviously, for bids, this VWAP, and for asks, this VWAP will be what kind of function of B, increasing or decreasing? consider increasing quantities. You construct the...
It would be increasing because the more we average, the higher price we are taking. Right?
You see, they are obviously increasing as you are going into the depth of asks. So for asks, it is increasing with B. But now consider VWAPs for bids.
It would be decreasing.
It would be decreasing, of course, because you would get prices 99, 98, 97, and so on. And more quantity corresponds to lower prices. So VWAPs for bids are decreasing with B. Okay. So you take standard bands and you construct those VWAPs. Okay. In our Moscow exchange setup, it's not going to be that much. 1 million, 2 million, 5 million, 10 million. 1 million is a very standard quantity for currency trade in those international currency platforms like EBS, Reuters matching, Hotspot FX, Caranex, you know, there are many of them. Then the typical trade size is, let's say, 1 million. But for the Moscow exchange, unfortunately, it is not 1 million yet. For the Moscow exchange, we will be using, okay, you have been working with this data actually. So what is the typical size available at the best bid, best ask in your observations? Did you make any sense of that data actually?
Like the volume of all asks or the volume of all bids?
Let's say not all, but if you consider the best ask, the best bid, what kind of quantity is typically available at the best price on average?
10, 20,000.
10, 20,000, you think so low?
Not sure.
It might be, but I think it is a little bit more than that. I think it is typically in the area of 100,000. So, by the way, why should we guess? First of all, we do have data available for you, but we can open up, let's say, the live Moscow exchange and to have a look right now. Let me have a look.
But isn't always the best ask or the best bids are low because they are being bought or sold? Like they are usually low.
Best bid and best ask are not necessarily the largest quantity. So you say, yeah, they could be low, but it is still an important indication actually of what kind of quantity in general you would have. Because obviously if you have 1 million at the best ask, best bid at any time, then the average trade size is also of the order of 1 million, something like that. But if you have only 10K at the best bid, best ask, then the average trade size is also going to be about 100K or less. So for MOEX, from which we got our data, I would propose that we use bands something like 100K, 200K, 500K, maybe, but maybe more bands, 1 million, and do a little bit more, 1 million, 2 million, maybe up to 5 million, something like that. These are our values of B, okay? These are our values of B. Now, if we have those values for B, we compute VWAP as a function of B. Is it already a quantity we would like to use, like, you know, we used for spectrum, you realize that it is the inverse thing compared to spectrum. Well, not exactly. We need to normalize VWAP. Normalize VWAP. We do not normalize the quantity in this case, or actually we may. We may normalize VWAP in two ways. So first of all, we're not interested in the absolute price. We need to compute the difference between VWAP and the corresponding mid price. So if this is the mid price and we got 100 in that computation 100.8 as the VWAP, we're interested in this difference, VWAP minus mid. So for asks, it will be VWAP of B, VWAP of B minus mid price. For bids, it will be other way around, mid price minus VWAP of B. For all values of D, we have selected, okay? Which is a kind of inverse map compared to the spectrum. The spectrum shows how much liquidity we have in the corresponding positions, and VWAP tells us how far we are from the mid price for a fixed amount of quantity, for a fixed amount of liquidity. So these are indeed, to some extent, mutually inverse maps. Also, the spectrum, there is another difference. The spectrum as we constructed it, the spectrum as we constructed it was using a relative quantity. So you remember we considered the total quantity situating in, for example, 50 layers, and then the spectrum was a relative one compared to this. Whereas here in bands, we are using absolute quantities, which is a kind of disparity. And this is a question of feature engineering, actually. Whether this is a good approach to use absolute bands in that case. Arguably, if we start using a relative bands, which we also can use, actually, but I would arguably say that for VWAP, we may want to keep absolute bands. In this case, B is not just, of course, you compute it for 100, 200, and so on, but you can view B as just an abstract band number. Band 1 for 100K, band 2 for 200K, band 3 for 500K, and so on. So you can say the bands are not necessarily volumes, but in this case, you can view them as mere numbers, some kind of fixed numbers for which you compute the separation of the corresponding average price with the midpoint. So let me call it in this case BI, and in this case you would construct it as a function, or actually as a function of I. where I is band number. Okay. So far, the spectrum and the VWAP are characteristics we have considered, are characteristics of the order book. So basically of liquidity being provided by liquidity providers or by passive quoters or by market makers. So basically those who provide liquidity passively or equivalently saying placing passive orders into the order book, they play the orders which indeed appear in the order book and they appear in our metrics. They appear in our spectrum or bands, okay? But what about, is it all we want to consider? Is there any significant extra information which we did not take into account yet? Something very, very big and very, very important, which we're still missing from our picture. What do you think?
Like from our picture of features?
Yes, from the picture of features being gradually constructed for the machine learning.
I guess we still didn't consider bid-ask spread.
First of all, yes, you're absolutely right. So let's say the feature number 1 is spectrum. The feature number 2 is the normalized VWAP as a function of a band. Yes, that's absolutely right. So feature number 3 is definitely the bid-ask spread.
But can't we reconstruct the bid-ask spread from the VWAP of asks and VWAP of bids?
A kind of, because you see, if we, for example, consider the difference, let's say take I equal to 1 for asks and bids. And then take the difference of VWAP of VWAP of B1 on the ask side minus VWAP of B1 on the bid side. This will be greater than bid-ask spread. This will be, so for example, as we have seen, the VWAP is something, some price which is higher than the best price for the asks and lower than the best price for the bid. So for example, here the best price is 100, but the VWAP we compute, for example, for 20, suppose that's our first band, is 100.8. So in general, we can only say that this quantity is greater than or equal to bid-ask spread. It will be equal to bid-ask spread if band 1 is small enough so that it completely fits in the best bid, best ask. So if B1 is completely located, is completely inside best bid and best ask, then obviously VWAP ask of B1 minus VWAP bid of B1 will be equal exactly, not just greater than or equal, but will be equal to bid-ask spread. But in general, the difference of VWAPs can be greater than bid-ask spread. And the difference of remote VWAPs, which correspond to distant bands, for example, for I equal to, let's say, 2, 3, and so on, for big I, this is definitely going to be bigger than the bid-ask spread. So by itself, VWAPs are not sufficient to ensure the bid-ask spread. And for that reason, I absolutely agree that the normalized, the bid-ask spread must be considered as a standalone feature. So that's absolutely correct. And yet, so this is feature number 3, yes. What else? Again, you see what we are doing here. We are looking at the snapshots of the order book when the order book is stationary in between updates. Typically, updates to the order book occur as a result of whatever trade happening, all right? So a trade happens and a part of the order book is eaten up, or let's say and the liquidity is taken. We'll say the liquidity is taken as a result of the aggressor coming. By the way, a very likely question in tomorrow midterm would be, I give you a picture of the order book, and then I ask you, okay, now let's say an aggressive lift or an aggressive hit come for the specified amount, please show the result, the resulting order book, the sequence of trades or matches generated as a result, and the movement of the midpoint, something like that, which is very elementary, but still you need to remember this mechanics, the order book microstructure. So what is missing? The dynamic features are missing, all right? And that is very important, ultimately important. So, so far, we only consider the various measures of order book construction and imbalance. For example, what would it mean if consider I equal to 1, and suppose that VWAP on asks at B1 is significantly greater than VWAP on bids at B1. Suppose that this happens. I mean normalized VWAPs minus mid price. By normalized VWAP, let's denote it by a bar. So normalized VWAP is VWAP minus mid price, or mid price minus VWAP if on the opposite side. So suppose that this normalized VWAP is significantly greater on one side than on the opposite side. What does it mean?
It means that there is like a lot of people who wants to sell at low price.
I would say completely different, completely opposite. If for a given quantity, that's not the spectrum, that's VWAP, that's the inverse thing. So you see, for a given quantity, let's say of 100,
yeah, understood. Like for a given quantity, it's very expensive.
Yes, the spectrum is much more rare, rarefied on the ask side. This means a rare spectrum on asks, because for the same quantity, you need to go deeper into the order book in order to encounter that quantity. And dense spectrum on bids, which means that there is a more pressure from the bid side. And now just a small, probably small order to buy would move the price very much likely into the upper part of our order book, which is a kind of indicator that the prices are probably going to increase. One of the features. So the features are precisely interpreted in this way. So basically, higher spectrum on the ask side probably means that higher spectrum on the ask side probably means that you are going to the price is going to go down, whereas a higher VWAP on the ask side is an indicator of the price probably likely to go up. But in our machine learning exercise, we'll need to take all those factors into account. Also, we may construct in the features like the very first one when we construct the spectrum, the normalized quantity. So how so far we have constructed the normalized quantity? The normalized quantity was a quantity at level J divided by the total quantity at 50 levels. That's how we did it, all right?
Yes.
You remember. You can consider another feature which might be, I would say, equally important and equally useful because we are using fixed bands here. You can construct 1A, and I would say probably use both 1 and 1A. Again, a spectrum, but now normalized quantity. Will be quantity at level J divided by your maximum band from 2. Because bands are precisely those cumulative quantity. So for example, if we consider in this very simple example, let's say the band of 10, then the band of 10 includes 6 units from the best price plus 4 units 4 units in 101, okay? But then if we consider the second band as a band of 20, and then it would include all same quantities from the price 100 plus the whole of 101 plus part of 102. If you then consider the band of, let's say, 50, then it will include all of them plus upper levels and so on. So you can, in 1a, you can use the second definition of normalized quantity as the quantity of a particular level divided by the maximum band, which is, let's say, reasonably advanced in from your feature set 2. And typically you would select the maximum band in such a way that this should be less than 1, although if your maximum band is such that somehow yes, it is probably in most cases will be less than 1 unless you are going very deep into the order book. So typically you would have it less than 1. So you can use this second kind of normalization in your spectrum, which is also important and also useful. So let us for the moment consider features 1, 1a, 2, and 3, and yet again all of them apply only to a stationary order book. They have nothing to do with how the order book evolves over time. So let us think what are 1a, what are further features we need to consider. 1a, 2, 3, they apply to a stationary order book between updates. Okay, so let's precisely call them feature 1, feature 1a, feature 2, feature 3. What else are we missing? There is something very, very, very important we're missing. And I can tell you we're missing the dynamic.
Maybe the time.
Yes, so what do you say?
The time.
Yes. How this evolves over time, something like that. So what are the temporal features we are going to introduce? So first of all, these order book features, if for example our task is to make a prediction, we are now at some time t, and we would like to make prediction of, here we are, and we are trying to make predictions over the next time interval from t to t plus tau, where tau could be, let's say, between 1 second and maybe 1 minute, something like this. We'll see. In order to do this, let's say this is t0. In order to do this, we may not only consider features, let's say here we have features 1, 2, 3 at t0, but we may also consider features 1, 2, 3 at t, some previous t minus 1, t minus 2, and so on up to a certain depth. So we may consider the history, okay? How deep this history is going to be found by our computational experiments, but most likely we should not restrict ourselves with only the features available right now at t0. If our stochastic process, which we are trying to predict, for example, we are trying to predict the mid price based on all this information. If this mid price depends only on the features at t0 and does not depend on the previous features, this is a so-called Markov or Markovian property of our stochastic process we are trying to predict, all right? Which may or may not be the case. So the property, for example, the price we are going to predict may or may not be Markovian with respect to time. Who knows? Probably not. Unless we have a model, a verified, a validated model, which can be validated under the Markovian property, there is absolutely no reason to assume a priori that this property holds, which means that we should probably assume some kind of history. And even this is not exactly what I meant. So history, yes, history does already introduce some kind of dynamism. So I would say this is important, but still, what else do we have? What kind of dynamic properties? Let's go back and first of all, what kind of other information do we have above, let's say, apart from order books? In the data, the raw data, which you were using, did you have separate data, separate from orders, data for traits? Well, it is
Yes.
actually the same files, traits.
Yeah, we have order log and traits log.
You got all traits.
Yeah.
And that is important. That is ultimately important. Because what are traits? The traits are events associated with the behavior of aggressors or takers. What kind of feature we are going to consider here? So I wouldn't put it at number 4 yet, but we need to take traits into account and construct features out of traits. So what kind of information we can infer from the traits? What do we have for the traits? For each trait, we have obviously time, quantity, price of the trait, all right?
Yes.
What else?
We have like stuff to identify the order, but this is basically what we have.
Sorry, what is the extra feature?
Like we have the order number, the buyer number, and the seller number, and the type.
Oh, okay, that is not that much useful in this setup, but I think we have something else actually for traits. In traits, we have an indicator who was the aggressor.
Yeah, like we have either it's buy or sell, so like according to that.
We have the aggressor. And you see, trade information is not very much useful, but I would say of limited use, if not this aggressor field available. But we do have the aggressor field available, buy or sell. So if the aggressor is the buyer, then actually trades occur as a result of matching of this aggressive order on the ask side. So if the aggressor is buyer, then the trade is a lift, all right? Because the buyer aggressively lifts the ask side and matches with the ask side. So matches occur on the ask side, all right?
Yes.
On the ask side of the order book. If the aggressor is seller, then this is called a hit, and matches occur on the bid side of the order book. Okay. This is ultimately important. Suppose that our statistics shows that on average over time, the number of, I would say, the total size of lifts significantly exceeds the total size of hits. What does it mean from the price dynamics point of view, typically?
That the price would go up.
Yes, this would mean that the price would go up and the other way around. So we will construct these features from the trade information. Trades correspond to liquidity taking rather than liquidity provision. Those who put liquidity into the order book, they provide liquidity to the order book, right? Trades typically remove liquidity from the order book. Well, of course. So what kind of features can we do? We can construct again for we have time intervals. For example, we're at t0 now, and we have t-1, t-2, t-3, and so on instance as shown here, right? What can we do? For each interval t k-1 tk, for example, including the more recent point, but not including the more distant point, we can compute, first of all, the total quantity of lifts and the total quantity of hits over some kind of, let's say, fixed time interval. You take a time interval. It's again actually a question how these time intervals are to be constructed. So for example, you can say t0, then the previous one, they do not even need to be uniform. You may even compute the non-uniform ones. So for example, t0, t-1 is, let's say, t0 minus 1 second, t-2 is t0 minus, let's say, 5 seconds, t-3 is t0 minus 15 seconds, and t-4, for example, is t0 minus, I don't know, 30 seconds or 1 minute, something like this. For example, it might be like this. And for each time interval, you would construct the total quantity of lifts and total quantity of hits within the corresponding interval. This one including or alternatively, it doesn't really matter that much. You can do it not between tk-1 and tk, but between each tk and t0. So they would just be, in this case, cumulative, where k is -1, -2, and so on. You get the total quantity of lifts and total quantity of hits over this fixed, let's say, fixed time intervals. Obviously, The total quantity by itself is not a good measure. We need to normalize it. So how do you think we would normalize this, this total quantity? Remember that using absolute values in machine learning is almost surely a bad idea. We should use relative quantities.
We can normalize by time.
We can first of all normalize by time, and you are absolutely right. So we divided by T0 minus Tk, which is positive because K is negative, okay? But also, again, in this case, we would have it in, let's say, dollars or euros per unit of time. Okay, but you remember that we were using the standard bands, like B1, B2, and so on. So why not normalize it by the maximum band, which we're using to compute VWAPs? In this case, the quantities are relative instead of absolute, are relative to the maximum band. I think it's going to be more useful, at least because you keep the number small, and this is a very good feature for non-linear learning algorithms. So for example, you divide it by the maximum band. Okay, so total quantity of lifts divided by time interval and divided by the maximum band. Okay, so that is this feature, which we denote by feature 5, all just for okay, which is called market pressure. There is a standard name for. Which is called market pressure. Okay, that's fine. What else can we do? Market pressure is about liquidity taking. So this is a metric of liquidity taking. Okay, by the aggressors. But there is also a certain metric of liquidity replenishment. A replenishment means that market makers or quoters replenish liquidity, they put extra liquidity into the order book, all right? How would we do it?
By putting passive orders.
Yes, they do it by placing passive orders. The question is, do we have information about placing passive orders into our order book?
Isn't it the order log, like where new orders come?
Generally, yes. When we go through our orders, we traverse our orders, then we do have information about the orders coming into our order book, right?
Yeah, so we can make the same thing, like the total quantity of left and total quantity of hits. We can say the total quantity of asks and total quantity of bids and divided by time.
You are right. So in this case, we can't use the order book snapshots by themselves. We need to keep track of more information as long as we construct the order books. In the course of order book construction, we keep track of extra information. So let us now consider this feature number 6, which is called liquidity replenishment. Or liquidity provision, or making. This was liquidity taking by the aggressors. Now it is liquidity replenishment or provision or making. Okay. But again, to construct meaningful metrics, we need our quantities to be normalized. So what can we do? We can consider a similar, by the way, sorry, returning to market pressure. If we returning to market pressure, if we only consider the total quantity of lifts and hits, we are losing information about trade prices. And
we can get the average.
And we can get the average, but the question is obviously, yes, about how to integrate this information. Actually, the price of a trade is a secondary auxiliary information compared to trade quantity, because obviously if you do execute an aggressive trade with a corresponding quantity, then the prices are direct functions of the current order book structure and the quantity. If you have the quantity available, then you can compute the trade prices. And yet, so let us think about this, and yet if we use trade prices, somehow, then it might be yet another useful feature which we can use here. How can we use it? For example, we have this mutually inverse, you remember, VWAPs and order book spectrum. So what we can do, if this is a midpoint and then there are asks and bids, asks and bids, and this is a midpoint, then there are intervals from midpoint. So this is empty bid-ask spread, and then, for example, spectrum starts to build, right? So this is 1, 2, 3, and so on, part of the spectrum compared to the midpoint. So when we get a price of a trade, we can calculate into which actually spectrum part. You remember, you are grouping them together. Into which spectrum part would this trade fall? Although I believe that in most cases it would come into the first part, because in your notation you group price levels 1, 2, 3, 4, 5, and then from 6 to 10 and so on. So most trades would really, trade prices would really belong to this. So not completely sure whether we can use trade prices or not by themselves. Maybe. So I would say maybe, please think about it. maybe extra features. We are doing exploration. We don't know. No one, neither you nor myself, have a magic bullet which would tell us which features to use. Maybe extra features from trade prices. Maybe, but this is questionable. Okay. Now liquidity replenishment. With the same timeline, you can compute the total in the simplest way. You can compute the total liquidity. I would still think about where it is coming, because if an order is coming very far into the order book, then and it replenishes liquidity, but not close to the best bid, best ask, but somewhere deep in the rear. It is not the same as liquidity replenishment at more distant, let's say more distant prices, at more close prices. So probably you would in this case again consider the order book spectrum. So you would have some spectrum, okay, and you would have some, not VWAPs, but spectrum really. You would have some, let's say, spectral line rather than VWAP band. And so, for example, I is 1, 2, 3, and so on. And you would compute the total passive quantity coming into each spectral band I, coming into each spectral band I within time from tk, where k is less than 0, to t0, not including tk, but including t0. And then in order to normalize it, we would say divided by same max band which you were using previously, just as a normalization factor. Divided by the same max band as previously used. So you remember there was a max band here.
Should we also divide by time?
And divided by time, you're absolutely right. So divided by this max band MB and also divided by time. Divided by, as we say, MB divided by T0 minus TK. So this will be for each I, for each K, you get this set of features. So you got quite a lot of features as a result, which describe both static composition of the order book and dynamic liquidity taking and liquidity replenishment. What is important is that you do it over different periods of time, going increasingly deep into the history. So for example, 1 second, 5, 15, and 1 minute. Using time scales like this would arguably allow you to capture both actually short-term effects, if for example you do have a feature for the last second, and long-term effects. Well, what kind of long-term effects? Medium-term effects, short medium-term effects. What is one minute? It is definitely not long-term. It is short to medium-term effect, whereas 1 second is, let's say, a short-term effect. So that's the information for you. What we'll do next in your practical sessions in your labs this week. When is the next lab? Wednesday and Thursday? Or Tuesday and Thursday?
I think it's Wednesday and Thursday.
Wednesday and Thursday, okay. So for Wednesday and Thursday, you will get an assignment for the labs related to implementing all those features. So we'll devise the format in which you generate the features and output them. From that point on, you will be ready for your machine learning, your first continuous price prediction exercise. And for today, I think we are done. Any questions, please?
One question about the last part about the spectrum. Usually, on average, how many how many steps in the histogram do we consider? Do we consider like the 100, like less? Because
how many? You mean here in 0.6?
Yes.
Steps in K or in I?
In I.
In I. No. You remember how you construct the spectrum now? You had altogether, you had 50 layers divided by 10 spectral bands by 5, right?
Yes.
So basically, in your case so far, I was 1 to 10. Each eye would include 5 price steps, right?
Yes.
So I would suggest to keep exactly same thing here. So it would be up to 10, and it would be 1, 2, obviously in the reverse order, up to 10 in beats. So you calculate the total replenishment coming into those spectral bands. So this let's call this spectral bands. Okay, and when we were considering VWAP, it was volume bands. So those 500K and so on, they are volume bands. They are different. Here the unit is the number of price steps, and here we use volume bands where the unit is other way around, the quantity. So these are volume bands, and B is measured in liquidity terms. So for the Moscow exchange, it will be this. Whereas here you use bands corresponding to the number of price steps from 1 to 5, from 6 to 10, and so on and so on. Okay?
Okay, one other thing. So among all these features, the only absolute features that we have is the mid price and the spread, right?
No, we take all those features together.
They are all together, but we normalized all the features except the mid price, right?
No, we're doing okay, mid price itself.
Yeah.
Mid price itself. We don't have mid price itself. We have bid-ask spread.
Yeah, the bid-ask spread is not normalized.
Bid-ask spread is not normalized But you know what? You are absolutely right. And I would like to thank you for this suggestion. You know what? I suggest that we may normalize the bid-ask spread by price step. So bid-ask, let us put it explicitly. Bid-ask spread normalized by price step. You are absolutely right in this.
And based on that, we make inference on the delta price change, not the actual next price, right?
Of course, yes. In that case, we wouldn't even be able to predict the next price. We would be able to predict by how many price steps it moves. But that's perfectly okay. That's really, really perfectly okay. What we want to do, because the original spectrum had precisely spectral bands calculated in the number of price steps. And you know what? This normalized VWAPs, this, let's divide by price step as well. Let's divide this by price step as well. Don't worry, you will have it once again in your lab, and you will get the exact feeling. So now everything is normalized by time, by price step, and by some kind of fixed maximum band, something like that. I think we are reasonably well normalized.
Yes.
Okay.
I have one more question, if it's okay. Yes. Can you scroll up, like to the very beginning?
Yes. Yes, here we are.
Yeah, in this formula we have square of n, like at the very beginning, square n dn less than k alpha, you see?
Yes, yes.
But shouldn't it be square n over 2? Because in the original formula for n and m, it's nm divided by n plus m. So in our case, n equals m, so it should be n over 2.
It's the opposite. N plus m over n multiplied by m.
Really?
Okay.
Yeah.
I am not putting the exact formula here, so it is just you know, a kind of indication that you know, square root of n should be here. So don't pay too much attention. And there are different formulations for Kolmogorov and Kolmogorov-Smirnov criterion. What we are talking now about is the Smirnov criterion with n and m. Okay. So don't take it literally. It is just some coefficient proportional to square root of n. Okay.
Okay.
So use whatever exact formulation you did use in Kolmogorov-Smirnov. That's correct. It is just an indication that something proportional to the square root of n should be here. So don't take it literally. It depends on the exact criterion. Depends on the exact criterion. Okay, but thank you for pointing it out.
Thanks.
Thank you. Then we are done for today. Again, later today, there will be, hopefully not much later today, an upload of our recording and of our whiteboard. And please feel free to ask questions in Telegram if you need something for preparation to midterm.
How many tasks will we have tomorrow?
How many? Not that many. I would say 5 relatively simple questions.
Okay.
Okay.
Thank you.
Don't worry much. This midterm is to just to impose some kind of very stringent tasks. It is more a continuation of teaching and a recap of just what we do know and what we don't. The mid-term evaluation points provided for the Department of Education will be a result of both actually midterm and your lab performance so far. So I still need to derive the common value talking to Alex, who is in charge of your labs.
But some labs are like deadline didn't happen yet.
Oh,
so some students might have.
No problem for those which have already been marked.
Okay, so for those for which deadline has passed.
For which the deadline has passed and they have been marked, yes.
Okay.
Okay, great. Thank you. Thank you very much.
Thank you. Goodbye.
Thanks. Bye.